Hello, thank you for joining me today. My name is Briant Sikorski, and I am an independent wealth advisor with Stratos Wealth Partners. As a wealth advisor, I help clients work toward achieving their financial goals by providing personal, business, education, insurance, and legacy planning. I provide access to investment solutions including stocks, bonds, mutual funds, and exchange-traded funds. Today we're going to be covering the LPL Financial Research 2015 Mid-Year Outlook, Some Assembly Required. In today's presentation, we're going to go over kind of three key components. Number one, how will the U.S. economy piece together the components needed to bounce back from its lackluster start of the year? After successfully delivering the U.S. economy out of the recessionary warehouse, how does the Federal Reserve, or Fed, assemble an exit strategy from its 6-year policy of zero interest rates? And finally, are corporate earnings growth going to continue to search for that spark to ignite equity advances? At the end, we're going to cover three different investment ideas, ranging from conservative to moderate to aggressive. And they may be investments that you've not heard of before. So I try to bring something different to the table. Now, as the business cycle transitions into its second half and the cross currents of volatile, disjointed global growth abound, navigating the assortment of pieces and using the proper tools will be vital to assembling an investment strategy positioned for success. The U.S. economy hit an unexpected soft patch at the beginning of the year, and this was due in part to a severe winter freeze, the West Coast port strikes, ongoing effects of lower oil prices, and the surging U.S. dollar. Returning to a more normalized 3% growth level will be crucial to build further upon the market's first half gains. Based upon the beginning of this year and our belief that corporate America will provide a much needed boost for the second half, we believe that 2015 will also furnish strong, providing the 7th year of positive returns, expected to be in the 5 to 9% range as we had forecasted at the beginning of the year. However, we do continue to expect roughly flat bond returns for 2015 as the choppy market environment witnessed over the first half of this year continues. The challenging low return environment confronting bond investors is likely to persist, and a slowdown in performance even for sectors that fared well over the first half of this year. So we're going to be covering some recommended upgrades to your portfolios, including emerging ideas poised to bring wattage to your portfolio. Some of the fundamental core connections or pieces holding together a successful portfolio strategy, and some expendable parts, which are investment pieces offering limited opportunity when added to the portfolio. Now, I'm always asked, Brian, are we on the verge of a recession? And our research department at LPL utilizes these 5 forecasting tools to determine, and as an advanced warning system, of an incoming or impending recession. These 5 data series have a significant historical record of providing a caution signal that we're transitioning into the late stage of the economic cycle and that recessionary pressures are mounting. As you can see from these 5, all 3, the Treasury yield curve, leading economic indicators, and market breadth are all in the no category, with only purchasing managers' sentiment and market valuation just slightly in the watch category. So if you look at the economy, step 1, We need that economy to restart its growth cycle, its growth glide. And we can see that any economy in the past history, including the last three expansions that began in 1982, 91, and 2001, they lasted on average about 8 years. By that measure, the current economic expansion still has room to build upon its progress so far. Regardless, the economic expansion has likely started entering its latter half. This is marked by strong economic growth, but also by potential for rising inflation, accelerating wage growth, and eventual Fed rate hikes. Since the beginning of the current economic expansion in the second quarter of 2009, the so-called good old American know-how economy has performed the old economy by a sizable margin. Good old American know-how is measured by combining the GDP of transportation and warehousing, finance and insurance, professional and business services, and arts, entertainment, recreation, accommodation, and food services. On the other hand, the old economy refers to manufacturing and is measured by good producing, excluding mining. Beneath the surface of the disinflationary environment, which is a period characterized by rising prices but at a slower rate than in the past, some inflation never disappeared. Service sector inflation accelerated since 2010 and remains poised to potentially move even higher as the economy accelerates, even though goods inflation, such as commodity, clothes, food, decelerated sharply in recent years. We continue to expect a modest acceleration in inflation over the second half of this year, enough to make the Fed reasonably confident that inflation will head back to its target of 2%. Now, action by the Fed will be reactions to key data hitting predetermined targets. We anticipate the first move possibly sometime at the end of 2015. Internationally, we expect Japan's economy, which we're showing here in the orange versus the U.S. economy in red, to continue to accelerate in 2015. This is going to be aided by the Bank of Japan's aggressive quantitative easing program, fiscal stimulus, and efforts by the Japanese government to ease regulatory and structural burdens on the economy. China, their economy clearly decelerated from the 10 to 12% pace of their own GDP seen in the first decade of the 2000s to about 7% today. But risks of growth slowing even further remain as China's property bubble continues to deflate during the first half of this year. In Europe, the Eurozone's financial transmission system, which allows credit to flow from the European Central Bank, or ECB, to banks and financial institutions, and finally to businesses and consumers, was very badly damaged during the Great Recession and its aftermath. In late 2014, the banking system started to heal in anticipation of the ECB's quantitative easing as money supply growth and bank lending picked up. Economies in emerging markets, particularly Asia, continue to grow faster than developed markets, driven by policy reforms and favorable demographics. Our monetary policy monitor, which measures the change in real GDP growth relative to other major economies on the vertical axis compared to a measure of each country's monetary policy horizontal axis at the end of 2014, shows a continuous rotation counterclockwise as monetary policies drive global growth. With stocks, we look for them to produce desirable year-end results. And the two big earnings headwinds for the first quarter of this year, energy and the US dollar, are starting to abate. Low oil prices have been a significant drag on energy sector earnings, which are expected to drop by 56% in 2015. Some volatility around the first rate hike in an economic cycle is normal, and this chart shows the performance of the S&P 500 around the 9 initial rate hikes after the end of each recession since the end of World War II, highlighting the recent dates 1983, 1994, and 2004, and the average. The S&P 500 moved higher 5 out of 9 times 3 months after the initial rate hike, but performance improved over time. The S&P 500 increased 7 out of 9 times over the following 6 months after a first Fed rate hike, with an average gain of 4.2%. We expect the pace of Fed rate hikes to be gradual. Therefore, we do not see the potential start of interest rate hikes as a big risk to the stock market over the balance of the year. With regards to stocks and their valuation, the trailing price to earnings ratio, or PE, of the S&P 500 index stands at 17.6 as of the end of May 2015. This is above the average of 15.1 dating back to World War II, but is reasonable when compared with the post-1980 average of 16.4. So this may allay fears of the stock market being overvalued or stocks being expensive. So how do we invest in the stock market? Well, at the moment, large cap U.S. stocks, and despite some headwinds from a stronger dollar, scale, strong balance sheets, and pricing power, trigger potential strong outcomes. Cyclical growth stocks, or companies in the industrial and technology sectors, are positioned to ride improving economic growth to better earnings and price returns. Emerging market stocks with favorable valuations, strong demographic trends, and the potential for stimulus to drive improved growth. And developed international stocks with the benefits of aggressive monetary policies driving accelerating economic growth across Europe and Asia. Conversely, U.S. defensive stocks, while with improving economic growth, this will favor cyclical stocks more than defensive stocks, or staples as they're sometimes called. And the backdrop of a potential Fed rate hike poses headwinds for interest rate sensitive stocks. With bonds, we want to be cautious because we expect bond returns to remain flat through the remainder of this year. This is going to be quite the contrary to what investors have experienced over the last couple of years. As you probably already know, bonds' real function is to generate interest income. However, for the last couple of years, or last several years, we've had not only interest income, but capital appreciation. And many bondholders are in for a bit of a surprise throughout the remainder of this year as that price appreciation starts to evaporate. Cross currents continue to buffer the bond market, leading to a push and pull on bond prices. So we can see that bond prices have had an up and down year so far this year by looking at the Barclays U.S. Aggregate Bond Index and their total returns. Bond valuations also remain very expensive. The inflation-adjusted yield of the 10-year Treasury note remains depressed relative to the historical average. This is especially noteworthy over the past 10 years, a period of generally expensive bond valuations. Although inflation may increase only slowly, it reflects just how expensive high-quality bonds are. The lesser the inflation-adjusted yield, the more expensive valuations are, and vice versa. Even if interest rates remain stable and do not rise, expensive valuations suggest caution when investing in particularly individual bonds. A market-friendly Fed is largely focused and has factored into the current market pricing as the Fed rate hike expectations remain lower and below official forecasts. So what this chart shows is the Fed's projections in red of their potential rate hikes, but the gray is market expectations, which are, in some cases, about half of what the projections have been published. They say beauty is in the eye of the beholder, and overseas demand is likely to stay elevated as yield differentials between U.S. Treasuries and overseas government bonds remain near all-time historically wide levels. The rise in longer-term interest rates may be restrained by foreign demand, which continues to look to U.S. Treasuries for additional yield. In an environment of low returns, higher yield investments should remain a focus. Maybe you've heard of high-yield bonds. Here too, however, some caution is warranted, and yield spreads between high-yield bonds and treasuries have contracted over the first half of the year, as measured by the Barclays High Yield Bond Index as compared to the 5-year Treasury yield. We continue to find municipal bonds amongst the more attractive high-quality bond options. While municipal bonds lagged their taxable counterparts over the first 5 months of 2015, as measured by the Barclays Municipal Bond Index, they returned 0.5% over the time period compared with the 1.2% of the overall bond market. But the silver lining here was much more attractive valuations, so much less overpriced. Refinancing volume makes up a record percentage of total issuance, and as a result, net growth of the municipal bond market is likely to be negligible at best for 2015, as issuance for new projects remains light due to still tight state and local budgets. So how do we invest in the bond market today? Well, we favor intermediate term, so those bonds that are have a maturity of maybe 5 to 15 years, as opposed to long terms that have maturities beyond that, or short terms that mature in less than 5 years. We also have they provide an attractive blend of diversification benefits and yield without the significant interest rate risk of longer maturity alternatives. We favor investment-grade corporate and high-yield bonds. Higher yields and strong corporate balance sheets buffer against an environment of low returns and rising rates. And finally, as we mentioned, municipal bonds with their tax benefits and appealing valuations make them amongst the most attractive high-quality bond alternatives today. On the other hand, we should avoid long-term high-quality bonds whose principal values will be negatively impacted much more severely than intermediate-term bonds, and also international developed market bonds. With their debt trading at historically low yields, they offer very limited returns today. Kind of as a sidebar here too, I think during market times like this, the topic of diversification comes to the forefront again and again. And the potential benefits of diversification are often cyclical, just like the nature of investments. during the past 15 years, and this is a period that includes 2 recessions, diversification has been a benefit more than it has been a penalty. And what we mean by diversification here is to have a broad portfolio of a number of different holdings rather than concentrating all of your holdings into what might be considered the next hot market. Now, in 2014, large U.S. Stocks were a standout. They finished the year, the S&P and the NASDAQ both finished up at 13.7 and 14.8% respectively, and they outperformed other diversifying asset classes like small companies or international stocks, as we can see here, by a very wide margin. So diversification involves a portfolio of different asset classes with the intent that these asset classes are not closely correlated. And we can see in this table where these numbers represent how closely these different asset classes correlate to the S&P 500, with one being a perfect correlation. So we can see that mid-sized company stocks have a correlation of about 0.8 to 0.9, small companies about 0.9, excuse me, internationals about 0.8, and emerging market stocks about 0.7 to 0.8. But notably, we can see that sectors like commodities and real estate have below average, by far below average correlation with numbers like 0.33 and 0.38. So we can see that while there's no single reason as to why diversification benefits do not materialize, the overall level of volatility seems to play a very outsized role. By using the level of the volatility index as a proxy for volatility, when readings have been high or above 24, a diversified portfolio has outperformed the market 88% of the time by an average of almost 6% over the next year. In periods when volatility has been low, diversified investments have trailed the S&P by a wide margin. So how do we diversify? Well, historically, most investors and advisors have worked with a ratio of stocks to bonds. Well, we've just talked about how bonds are expected to be flat, if not negative, for the remainder of the year. So what would we combine potentially with our stocks to provide diversification without a almost guaranteed flat to losing bond proposition? Well, that would be to include investments like a global macro alternative strategy with diverging global economic backdrops. This benefits their macroeconomic analysis and forecasting. Manage futures and again, another alternative strategy. Cross currents of strong currency and commodity trend offer opportunities for these momentum and pattern following strategies. Master limited partnerships, which are in the oil and gas field, benefit from the stabilization of oil prices. Conversely, we would avoid commodities with modest global demand and a stronger dollar, limiting their upside. Traded real estate with rising valuations in the backdrop of higher interest rates. And maybe some themes to consider incorporating in your portfolio, such as a energy renaissance as the U.S. creates a new economic, social, and trade dynamic for global markets as we move towards energy independence. The rise of the millennials is a trend. How business is done is much different for this increasingly connected yet distant group. I know yesterday I walked into Panera Bread and there was literally only one person working at the counter because Panera has installed these little, iPad type touch devices, and the millennials come storming in with their smartphones in hand, order up and pay for their meal, run over to the pickup window, grab it to either eat in or go, and never talk to a human being in the whole process. Perhaps the same thing is happening in some of your markets. And finally, a resource-strained globe creates pockets of scarcity together with advances in sustainability, which will shape future development. So with the scarcity of certain materials and the focus on sustainability, that might be an opportunity for us. Now with that, I had committed up front to providing you insight into maybe a few different investment ideas, perhaps something you've not heard of, and it's going to actually play off of these themes. So if you are a conservative investor or a conservative component of your portfolio, you might want to look up and research or refer to this brochure on what is known as a market-linked certificate of deposit or market-linked CD. So market-linked CDs generally consist of a bank deposit linked to the performance of a reference asset. These are versatile tools that may serve a range of functions in an investment portfolio. They typically have a maturity of 1 to 10 years. They're linked to the performance of one or more underlying reference assets, which include but are not limited to stocks, exchange-traded funds, commodities, interest rates, currency, exchange rates. And the real value of the market-linked CD is for the conservative investor or for the conservative component of your portfolio is the fact that they are FDIC insured. So they offer the potential for a greater return than just a CD if the index to which they're tied were to rise, but at the same time, they guarantee no loss of principal. Now, your upside potential may be limited by caps, but nonetheless, with such a low interest rate environment and with our forecasts of 5 to 9% in the stock market, this might be a real good alternative to CDs or other fixed income investments, which we profiled as being flat to even negative this year. Now, for the moderate investor or perhaps someone who is looking to invest something or make a purchase in their moderate component of their portfolio, I've profiled something here called the fixed indexed annuity. This is something you may or may not have already heard of, but essentially annuities come in 3 flavors. Baby Bear, you might say, is a fixed annuity, which in many ways operates very similar to a CD. Mama Bear, you might think of as the fixed indexed annuity, which we're going to discuss here a little bit more. And Papa Bear might be the variable annuity, which gives us full reign to invest in the stock market and get outstanding returns, but also outstanding losses. So again, a key factor here is that instead of buying a CD with FDIC insurance, here we're making an investment with an insurance company. In this example, it's MetLife. And again, just like the market-linked CD, what we do is we link our performance to some external index. And the good of this, and this we talked about in diversification, is the market-linked CD will lock in upside performance and essentially ignore downside performance as seen in this chart. So again, they come with different yields, different maturities, but we can see that with, again, 10-year Treasury yields being so low, we might want to look at an alternative such as this. Again, it's really designed to give you the middle to middle high performance. It's really designed to maintain your principal as well, and it's backed by the essentially the financial viability of the insurance company that we purchase it from. So what it kind of tells us here is we select the level of protection that we want. We can protect all of our principal, or we can select percentage of losses that we don't want to exceed. If it's 15, we select the maturity, we select the index that we want to be tied to. We also have additional riders or guarantees that we can lock in if we so choose. So again, the real key component here is to protect you on the downside. Now for the perhaps aggressive investor, or the investor who is looking to fill out a component of their investment portfolio, or perhaps the, if you want to call it not necessarily the aggressive, but the alternate or non-stock component of their portfolio, alternative investments might be an idea. We kind of generally talked about those in the presentation, but this brochure will tell us about the role of alternatives as being something to buffer volatility in the stock market. This gives us the ability to select investments in many cases that we couldn't, a few years ago, could not avail ourselves to. So this first line is indicative, where it says that alternative investments are quickly gaining traction in the marketplace as an attractive option for investors to potentially diversify their investments, manage market volatility, and provide alternative sources of return. So this kind of complicated chart is essentially showing us that in any given year, no one investment is always the top performer. We can see, just as an example, where in gray we see the small emerging market in 2007 was the #1 performer, but in 2008 it had flipped complete 180 and became the worst performing performer. So we're trying to bundle these together to create a middle of the road, if you will, a midpoint performance by combining different asset classes. So the types of alternatives that we can incorporate include hedge funds or a hedge fund of funds. These offer investors a dynamically managed portfolio of hedge funds that attempts to minimize the risk of investing in a single hedge fund strategy. Managed futures, which invest in futures contracts. So futures contracts are essentially what the price of certain commodities might be at some future date. This is typically with a focus on currencies, global stocks, interest rates, and commodities, mostly energy, metal, and agricultural markets. And this is a contract or an agreement to buy or sell a particular commodity or financial instrument at a predetermined price in the future. This is kind of interesting. It shows the kind of green, the kind of green, yellow-green shows our U.S. stock market with its volatility up and down. The orange are international stocks, which you can see there up and down, up and down. But you can see where the incorporation of managed futures offered a smoother ride. You kind of perhaps missing out on some of the huge upswings, but at the same time buffering against the huge downturns. Private equity is essentially private transactions in public or private companies. So this strategy seeks to provide better risk-adjusted performance than publicly traded stocks over a longer period of time. And you can see the different types of private equity here, including venture capital, mezzanine financing, leveraged buyouts, distressed debt, and other special situations. Private debt, investing in the private debt of U.S. companies. And these are non-traded companies, business debt. And real estate via real estate investment trusts. These are investment vehicles that invest in commercial real estate or real estate related debt. And this shows us some of the differences between traded and non-traded real estate investment trusts. So with that, I will say thank you very much for joining me. Please feel free to look at my website, BriantSikorski.com, for more information. From there you can learn more, research more, read more, and it will also give the ability to jump over and link to my Facebook, LinkedIn, Twitter, and YouTube pages. Thanks very much, and have a great rest of your day.